Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a bunch of different comments you guys make. I'd like to respond kind of to everyone, give you my financial opinion. One of the questions that someone was coming up with, it says gold went up because of Russia invasion issues. If that calms down again, gold and silver will go down again. How sure are you guys of all this? I mean, a lot of people think that it's just going to go right back down. And if you look at the gold chart, we've got this massive pattern that's developing, and it's putting in a bullish engulfing for a breakout to the upside. Did that war create this pattern? Yes or no? Now, another question is, if the war created the pattern, which it might have, hard for me to know. We have a bullish engulfing on the monthly candlestick basis that's showing that this thing's going to break to the upside. Does it matter what the catalyst was to break out of this pattern? In my opinion, no, it doesn't matter. It's there, it's breaking out, and I don't think you can unbreak this big pattern. It's a pretty large pattern. And the conditions that have shown me that, the market conditions that show me that gold goes up, they're all present. So what makes you think that this is going to come back down when all the market conditions are present? Now, there could be a gap between the stimulus money that they were playing with and the credit expansion from the loans in the housing expansionary phase. What is that transition going to look like? I don't necessarily know. And I don't know if this is being pushed necessarily by the war. I don't know what the reasoning is. And that's why technical analysis I like a little bit more than fundamental analysis, because fundamental analysis doesn't get you the picture. The picture is painted right here. The market's telling you we're breaking to the upside. Doesn't matter what the reason is why. That's my opinion on it. You can say, and it seems like a lot of people, all the bears, whether it's bulls or bears, whenever you have to fabricate a story or rely on something that hasn't happened, or you've got data that isn't being shown in, say, inventory numbers, they're going to be wrong, in my opinion. And you have to wait until your inventory numbers change. So, for instance, I've been hearing that we are in a housing bubble for multiple years now. Since the medical event in 2020, people have been saying, we're in a housing bubble, we're in a housing bubble, we're in a housing bubble. I'm like, no, we're not in a housing bubble. You can't be in a housing bubble with no inventory. You are in a housing shortage. You are in something that's going to drive housing higher because you have no inventory. The inventory isn't there. Oil's doing the same thing. We're sucking through inventory. It's going down. And people are saying, well, we could have this big pullback. There's no inventory. How are we going to have a monster pullback with no inventory of oil? I mean, we have inventories. They're just getting depleted. And then we've got gold here. We've broken to the upside. We've made a higher high. Does it matter what news is behind it? Maybe, maybe not. But to me, it looks very good. And if we get a pull up to, $2,000 something, and even if we pull back, I don't know if we're going to be going below this chart or not. We'll see. All of the market conditions that I look for are supportive of higher precious metals prices. They're just starting to get into gear. So I wouldn't bet against it. I would be holding on. I would be long precious metals, and I wouldn't worry about some of those other things. But that's me. Says, Andy, how did gold behave in the last war? In all honesty, guys, my data from what I looked at, it all correlates with the housing starts and an increasing credit cycle. So in the 1970s was the most explosive move because they were printing money and they held gold down with the price. And then when it was freely traded, there was a large imbalance of money that wasn't accounted for in the system. And the market conditions were ripe for the accounting of gold to account for that money supply, were ripe for that revaluation. And that was an expansionary phase of real estate, a highly inflationary environment with increasing interest rates. Those increasing interest rates forced people out of bonds and out of stocks and rolled over into precious metals and commodities and real estate. Real estate had massive moves back then in the 70s. And I know people, they say that some people think that we are like in the 1940s. I'm going to pull up some data here. If I can find it. Here it is. Get me out of the way. It says annual U.S. housing starts 1890 to 2015. This is the housing starts. Thousands of starts. This is your time. This is your private starts. Here's your public starts. The private starts is really the ones that I would be looking at. Now, we had a level that was an average of about 250 in here. Whenever we went up over 250, we had a large housing expansionary phase in the 1920s. It went below the average in 1929. What happened in 1929? Oh, that's right. That was the Depression and the Great Depression. What did it come from? Housing starts declining. That is your deflationary move. They had a loaning. They were giving loans out to everybody, just like the mid to late 2000s. That was the mid 1920s, and then it all started to collapse. The 1930s was the reckoning of all that. In the 1940s, we had a housing boom. Did you know that? And we went far beyond anything that we've built. The average was down here. We went a little bit below the average, and then we just blew to an entirely different level. This is highly inflationary based off the housing starts. Highly inflationary in the 1950s, 1960s, and then we even went higher in 1970 and had another elevated period of high home starts all through here. So I think it's all being driven by this chart that's behind me, the housing starts. Every time the housing starts goes up, we go into an inflationary period, it seems like. And that inflationary period is accompanied by higher interest rates. Now, when you look at this chart, it's about the change in volume. So this is changing in volume the entire time, which is an inflationary period. It put a bunch of money into the system, and when you're on a gold standard that was fixed, it means a bunch of money was created during this time frame, but it couldn't account for it till over here, until it was freely traded. This here, after the 70s, kind of came down lower. We had a lower high, and then we were coming on down, and then we had another move up in here. So there's another cycle in this within, these cycles. There's other cycles going on behind it. What I think's coming is a inflationary period with this on top of it. That cycle, and I think that interest rates will go up higher, which will force money out of stocks and bonds and into precious metals and commodities. Does this have anything to do with war? It doesn't. It doesn't. But you know what? Weird things happen in how things correlate and how people assert certain things and give importance to certain things in the markets. Coming on down, it says Kathy Wood is a mess. Whatever she does, do the opposite. Yeah, pretty much. I don't know where she thinks that deflation comes from technology is deflationary. I don't define deflation by consumer price index numbers. It's just credit expansion and the destruction of credit. So money coming into the system's inflationary. Money being destroyed in the system is deflationary. The conditions for an inflationary boom are there. She will be wrong. That is my opinion. We will not have deflation. Even if the stock market crashes, that doesn't mean that you have deflation. It means that probably interest rates are going up and that the stock market is priced for low interest rates. When interest rates go up, it means you have inflation. Interest rates don't go up during deflationary times or during very low inflationary times. They go up when you have high inflation. So, and we'll see how long-lived this inflationary boom is. We'll watch it and continue to monitor it. It says, hi, may I know which state you lived in and which state you recommend people to buy a house in? I'm in Colorado. We have a booming real estate market. It's probably up there with some of the top states. I honestly, guys, I don't know. I'm not like the all-knowing real estate expert where I know exactly which states are the best. And the best state to buy in would be the one that you like the most in, and that is changing from a out of favor to favor state. You probably don't want to jump in the hottest markets like Boise, Idaho, or some of these other ones that have been growing quite substantially. Maybe you do. Usually the West is the ones that move the most. They're the most volatile, is anything in the West. So that'd be states like California, Idaho, Colorado, Arizona, Nevada. Those are the ones that move the most, generally. And they're usually the most volatile. But when they go down, they're also the ones that crash. So those are the ones that are the most volatile, at least in my opinion. It says gold and oil popped and general markets dumped with growing fear of war between Russia and Ukraine. So I'm not getting too excited yet. If the war that threat subsides, then gold will fall hard. Seen this so many times. We'll see, guys. We'll see. We've got a big broken pattern. And I'm just waiting to see what happens. I can tell you this. It sure looks positive to me. That's what I'll say. It sure looks positive. It doesn't look negative. Looking at this, is this just the Ukraine stuff? Surely we can give it all back next week. Well, we'll find out. We'll find out. You guys are so negative. So negative. Market snipers calling for a deflationary crash in precious metals soon. Any opinions on it? No. We were not going to have a deflationary crash, in my opinion. I disagree. Now, could precious metals go down? Yes, but it won't. It's not going to be a deflationary crash. A deflationary crash means that you're having credit being destroyed. At least that would be the driver of it. So we would have to have a crash in the housing market. We have no inventory for a crash in the housing market. So I am suspecting that no deflationary crash is coming. That's my opinion. Now, he obviously does a lot of technical analysis. He looks at the charts. He looks at relative foreign currency exchange things. What I'm looking at is the driver of those. At least that's what I think. I think I'm looking at the driver of it. The driver of it, in my opinion, is the real estate housing starts volume, which is the lending that goes against it. The lending that goes against it is an inflationary cycle. It's a credit expansion. More loans are coming into the system. So by definition, if you get a movement in gold it would be under an inflationary move, and it would be a pullback that would be unwarranted, in my opinion. A deflationary crash means that you have that loaning cycle is disrupted, that you went into a recession in the housing starts, and that the loaning went away against it, and that you're actually destroying credit in the system by home prices going down. The home prices going down would put loans underwater. People would foreclose on their house, and then that credit would be destroyed. That is deflation. We've seen that basically every deflationary crash that we've had, there's been problems in the housing market. Very few times in history have we had any sort of crash that was not associated with the housing market. We did have a recession, the dot-com bubble. That is exactly what I think is coming, is that type of bubble. Now, I could see how somebody would say that we are going to have a crash in those markets. And I agree with that. Let's take a quick look real quick. Just to show you, they are rolling over. Here's the S&P 500. We have a rising wedge, and it is rolling over to go lower. So I agree with that. We have the larger selling pressure. It came up in a bounce, and we're going to head lower. I totally agree with what he's thinking there. But this isn't the driver of inflation and deflation. This is just telling us that we have higher interest rates and that these stocks were priced by low interest rates. And when interest rates go up, this is going to crash the market. But it's going to be contained, I think, in this area. The driver of it is the U.S. housing starts, which is this chart here. This is your driver. If you want to see a crash, this has to be going down here. Problem is, we are up here and going up. Permits are going up. Housing starts are going up. We don't have a deflationary crash. This is a deflationary crash. This is a deflation. 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 There is no inflation up here in history for a deflation that has happened with the housing starts going in the upward direction. It's never happened. So what do you think is going to happen if we are above the average going on up in a housing starts? We're not going to have deflation, in my opinion. That's why. That's the reason why I don't think we're going to have it. Now, I blew right by it. Just 1 second, guys. The Dow Jones Industrial Average to gold. This is the ratio. It is favorable for gold. It is coming back down. Under this scenario, let me see here. We can back out a little bit longer. There we go. There we go. So usually what happens is we come on down here, and this isn't a deflation. This is all inflation. Inflationary periods, this is in 65 where it peaked, and we bottomed at 1980. Now, there could have been a deflation on the back end here. But usually what happens is you come on down, and then usually you can get a little deflationary little jolt at the end when this cycle ends, and then you come back up. So at the ends of these cycles is where you'd get these deflationary busts. The ends of these cycles. The beginnings are all started with inflationary booms. And then we had another inflationary boom, and so forth. These ones in between were large declines in interest rates for the most part. And then somewhere in the middle of this cycle here, on the tops here, that is when you start getting into a commodity boom. And it depends on valuations of the stock market and whatnot. But usually what happens is you start these cycles with a low inflationary environment, and that environment starts to change over time. Same with every single cycle here. It changes over time. We start heading lower. All these ones coming back, we had increasing interest rate environments and higher inflation than what we had before. This was, and some of these, I mean, just like this was a big boom coming on up where it boomed quite dramatically under an inflationary period here, and then it all collapsed. So I think that we are going to have a stock market that comes under pressure and goes lower. I think that we are entering an inflationary period because of the housing starts, and I don't see a deflationary crash. That comes from housing starts declining, and it comes from foreclosures in the real estate market. And that market is incredibly hot, and I don't see any inventory in that market. So I don't know how it's going to happen. We'll end it there, guys. It's about the 20-minute mark. Give me a thumbs up if you guys like the content. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.